Why has homeownership become financially impossible for the average person? We are currently in a 30-year housing freeze with the lowest transaction volume since 1995, yet prices remain at all-time highs. This directly contradicts the basic economic rules of supply and demand. Typically, when fewer people buy, prices drop. Today, that is not happening. The reality of this economic shift is that the average first-time buyer is now 40 years old. This is a permanent structural change in the market, not a temporary phase. In this video, I will explain the interest rate anchor stopping owners from selling, the 4 million unit housing shortage the media ignores, and the specific data Wall Street uses to profit from your debt. I am providing a clear financial strategy to protect your capital while the market remains broken. Are you in your 30s and still renting, or an owner who cannot afford to sell because of current interest rates? Comment your age and city below. The law of statutory paralysis. The median home price in America currently sits at $418,000. Just 5 years ago, that figure was $272,000. That is a 46% increase on a national scale. We are not talking about luxury penthouses in Manhattan or tech estates in Silicon Valley. We are talking about the dead center of the country. This price explosion occurred simultaneously with a violent shift in the cost of capital. In January 2021, a 30-year fixed mortgage was 2.65%. Today, you are looking at roughly 6.5%. To the uninitiated, these are just numbers. To the visionary, this is a total transformation of the financial landscape. Consider the math. On a $400,000 home with 20% down, a 2.65% rate resulted in a monthly payment of $1,293. At today's rate, that same loan for the exact same house costs you $2,023 a month. You are paying an additional $730 every single month for 30 years. That is nearly $263,000 in extra interest over the life of the loan. You are paying more for the debt and more for the asset simultaneously. This is the definition of a financial pincer movement, the architects of the void. This was not an accident of history. It was the predictable output of a sequence of shocks. In 2020, the Federal Reserve entered a state of emergency panic. They slashed rates to zero and began an aggressive campaign of quantitative easing, injecting $120 billion into the financial system every month. They were essentially performing open-heart surgery on the economy with a sledgehammer. By January 2021, they had created the lowest mortgage rates in recorded history. This was the lure. Then the psychological landscape shifted. The pandemic turned your home into your fortress, your gym, and your boardroom. The 700-square-foot urban apartment became a sensory deprivation tank. Remote work exploded from 6% to 18% almost overnight. This triggered a great migration. Hundreds of thousands of households fled high-cost hubs like San Francisco and Chicago, descending upon cities like Austin, Nashville, and Phoenix. These markets, already suffering from tight inventory, were hit by a stampede of buyers armed with pandemic savings and cheap credit. In 2 years, Austin saw prices climb 61%. Phoenix jumped 59%. We saw 6,000 homes a month selling for $100,000 over the asking price. Those who bought in 2020 or 2021 did not demonstrate financial genius. They demonstrated accidental timing. They locked in a financial instrument that no longer exists and likely never will again. For everyone else, the door didn't just close, it was bolted from the inside. The interest rate anchor. By mid-2022, the inflation dragon had awoken, reaching 9.1%. The Fed reacted with the fastest tightening cycle in 4 decades, raising rates 11 times in 16 months. Mortgage rates spiked from 3% to nearly 8% in the blink of an eye. This created the lock-in effect, but I prefer to call it the interest rate anchor. Currently, 51% of all outstanding U.S. mortgages are below 4%. Roughly 20% are below 3%. If you're a homeowner with a 2.75% rate, you're holding a limited edition asset. The bank will not recreate it. If you sell that house today to move, You are voluntarily surrendering the cheapest capital you will ever see and replacing it with debt that costs double. On a standard mortgage, that swap creates an $87,000 penalty over a decade just in interest. This is why the market has stopped moving. Rational human beings do not trade a 3% loan for a 7% loan unless they are forced to by death, divorce, or disaster. The spreadsheet is physically keeping people in homes that are too small or in neighborhoods they no longer like. The Federal Reserve has estimated that this effect has suppressed 1.7 million transactions. The market isn't crashing because nobody is selling. It is a stalemate between a buyer who cannot afford to enter and a seller who cannot afford to leave. The sacrifice of the builder. Let us examine the human cost of this structural failure. Meet Maya. She is the avatar of the current struggle. At 31, working in healthcare administration, she earns $74,000 a year. She has a 760 credit score and zero credit card debt. She has spent 3 years living like a monk, skipping vacations and keeping a roommate far longer than she desired to save $31,000. In any other decade of American history, Maya would be the ideal candidate for homeownership. In today's market, the math laughs at her. In her mid-sized city, the median home is $385,000. Even with 10% down, her total monthly carry, including taxes, insurance, and maintenance, is $3,010. Maya's take-home pay is $4,650. Housing would consume 65% of her income. She would be left with $1,640 for food, utilities, health insurance, and student loans. Maya is not failing. The math is broken. To comfortably afford that home, she needs an income of $110,000. She is $36,000 short of the entry price for a middle-class life. Are you a homeowner who feels trapped by your low rate, or a buyer who feels locked out by the high ones? Comment, owner or buyer, below. Let us see who is truly bearing the weight of this frozen market. The extinction of the starter home. The shortage of inventory is not a recent phenomenon. It is the result of 15 years of deliberate underbuilding. Following the 2008 crisis, builders were traumatized. Throughout the 2010s, housing starts averaged 990,000 per year, far below the historical baseline of 1.5 million. Furthermore, the industry abandoned the working class. The traditional starter home, under 1 to 400 square feet, has essentially been discontinued. Production of these units has plummeted 80% since the 1970s. Builders focused on the luxury tier because that is where the margins reside. Now we face a deficit of 4 million housing units. Layered on top of this are new tariffs that have sent the cost of steel and aluminum up by 50%. Canadian lumber is up 45%. These supply chain shocks add up to $7,500 to the cost of every new home before a single brick is laid. There is no policy lever, no executive order, and no interest rate cut that can conjure 4 million homes out of thin air in a year. We are looking at a decade-long resolution process. The 2008 myth. Whenever I discuss this, people inevitably ask, is this 2008 all over again? The answer is a definitive no. In 2008, the system was built on a foundation of sand. Subprime mortgages, liar loans, and negative amortization products were mainstream. The banking system was betting on home prices using money borrowed against itself with zero margin for error. Today, the situation is the inverse. The lending is sound. The median credit score for new mortgages is 758. In 2009, 26% of all mortgage properties were underwater. Today, that number is 2.2%. Homeowners are currently sitting on $35.8 trillion in collective equity. We are not seeing mass defaults because people have massive amounts of skin in the game. The problem in 2008 was that people had houses they couldn't afford. The problem in 2024 is that people have equity they can't access, and buyers have incomes that the market no longer respects. This is not a fragile market. It is a frozen, high-pressure environment that is absorbing more and more of the average person's income. The mirage of the rate cut. Everyone is praying for a significant drop in mortgage rates. While it would offer some relief, the visionary understands the hidden danger. If rates were to drop to 5% overnight, the millions of buyers currently sitting on the sidelines would flood back into the market simultaneously. But because the supply deficit of 4 million homes still exists, this surge in demand would likely trigger a secondary price spike. The cure, if administered too quickly, could make the disease worse. The most honest forecast is the one that the media finds boring, a slow, multi-year grind where prices move sideways while incomes gradually attempt to catch up. We are in a war of attrition. The strategic rebellion. If you are in your 20s or 30s, you are navigating the most dysfunctional housing market since the Second World War. It is insidious because it doesn't feel like a crisis. It feels like a permanent new normal. You must realize that every institution, the banks, the real estate portals, the agents, has a financial incentive to convince you to buy. They do not profit when you say no. You must stop viewing renting as a failure. In a high-rate, high-price environment, renting and aggressively investing the difference into a diversified portfolio of productive assets, like an S&P 500 index fund, is a legitimate capital preservation strategy. There is no commission for an agent when you buy an index fund, which is why they never suggest it. If your total housing costs exceed 30% of your gross income, you are not building an asset, you are building a cage. What is the one luxury or life milestone you have sacrificed to chase the dream of a home? Be honest. Sharing your story here helps others realize they are not alone in this structural squeeze. Comment below. The law of the new era. The era of buying any house at any price and assuming appreciation will bail you out is officially over. We have shifted from a market of momentum to a market of fundamentals. If you must buy, look at new construction. Builders are currently the only ones with the margin to offer rate buydowns, sometimes as low as 4.5%. Because they need to move inventory to satisfy shareholders, they are acting as the shadow central bank of the housing market. But even then, you must run the numbers. Do not buy the narrative, buy the math. The final philosophy. The housing market is currently a mirror of the broader economic divide. We have a generation of homeowners locked into 3% rates, sitting on $35 trillion of equity, effectively insulated from the Fed's actions. On the other side, we have a generation of strivers like Maya who are doing everything right but are being taxed by a broken system before they even enter the room. Understanding this is the first step towards sovereignty. You are not failing at adulthood. The system has a $22,000 gap baked into the average family's income relative to the average home price. This is a structural failure, not a personal one. Your job is not to fix the market. Your job is to protect your capital and wait for the math to align with your reality. As for those of you still watching, I want to leave you with a hard truth that the 1% knows but the average person ignores. Real wealth is not found in a primary residence that consumes 65% of your income. Real wealth is found in liquidity and the ability to pivot when the rest of the world is frozen. If the market is stuck, you must remain fluid. Do not let a cultural obsession with a white picket fence lead you into a financial slaughterhouse. If you have read the data and you are ready to stop playing a rigged game, comment, "I am awake" below to let us know you are part of the community that chooses math over emotion. At Here, we don't provide comfort, we provide the truth. Like this video and subscribe if you want to stay ahead of the curve while the rest of the world remains frozen in the past. It is an exchange of value. We provide the insight, and you help us spread the message of financial sovereignty. Now you have the data. The next move is yours. Watch the next video on the screen to continue your evolution